RBA just raised rates for the second time in a row. Your repayments have probably gone up by around $160 a month compared to December. And most people are just absorbing it, hoping that next month is down. That's not a strategy. In February, the RBA increased the cash rate to 3.85%. In March, they pushed it to 4.10%. That's 2 consecutive hikes in the first time since 2023, driven by inflation, energy costs, and global instability. But here's what most people have missed. Some lenders have increased their variable rates more than 0.25%. They've used the RBA move as a cover to widen their margins. The problem is not that just rates have gone up. The problem is that most borrowers have got no idea whether they're paying more than they need to. They've seen the headlines, they feel the pinch, and they move on. But here's the reality. If your lender has increased it by 0.3% instead of the 0.25% on a $600,000 loan, that's an extra 0.05% costing you around $300 a year. Multiply that by the life of the loan, you're looking at thousands in margin creep that you never agreed to. And most borrowers never check. Their lenders know that. And the reality, here's exactly what they see in practice. The gap between what existing customers pay and what new customers have been offered has widened again. Roy Morgan data shows 26.6% of all mortgage holders, that is 1.319 million Australians, are now classified at risk of mortgage stress, up from 23.9% just 2 months ago. But mortgage stress isn't eventually a disturbance. Borrowers who have reviewed their structure in the past 12 months are in far better shape than those who have not touched their loan at all since it was set up. The structure is the difference. Being absorbing rate rises and being crushed by it. Here's what to do. First, check your current variable rate against your lender's advertised rate for new customers on their website. If there's a gap for more than 20 basis points, you are paying loyalty tax. Call your lender or call your broker and ask for a rate match. Second, look at your offset. Every dollar in savings that's not in your offset is costing you interest. Third, if your loan structure has not been reviewed since it was originally set up, book a structure review with a broker, not to refinance, just to understand whether your current setup is working for you or against you. A 30-minute review can reveal thousands in savings that you never knew existed. 2 rate rises do not have to mean 2 months of stress. They should mean 1 structural review, because the borrowers who came through the rate cycle are in the best shape, are not the ones who earned the most. They're the ones that loans are structured properly. If you want to understand how your loan is actually set up, click the link in the bio.